Good day. Welcome to another session on our Entrepreneurship Master Program. Today we're looking at the topic managing finance for a business or manage business finance, which is the skills program. Generally, it's called finance for non-financial managers. So we're looking at how you manage your finance in general. And the module that we're looking at today is on bookkeeping. But before we get into bookkeeping, maybe I'll just give a little bit background on finance, on how is it important for a business, and why should the business or entrepreneurs make sure that they maintain proper financial management system. Entrepreneurs go into business because they want to make money. That's the main thing. Yes, you might want to make a difference, contribute to the community. There's a lot of things. Maybe you are doing your passion, or you are doing something you want to freedom. You want to work whenever you want to work. But the bottom line is entrepreneurship is about taking an opportunity or identifying an opportunity, taking advantage of that opportunity so that you can make economic benefit. Okay, so when it comes to finances, on the one side is you need to make sure that you maintain financial records, you keep your books, and on the other side you need to make sure that you make profit. So you'll use your income statement, balance sheet, cash flow to assess if your business is making money or is making profit. With this lesson, we're going to start with the bookkeeping, but I just want to give an overall picture of finance. So bookkeeping is you are keeping the records, and the accountant or the financial manager will prepare your books basically to show if you are making profit or not. That's the first objective. The second objective is you have certain things that you need to comply with, like your submission of your tax returns, or your VAT returns, or your QADA. There are certain things that you have to pay based on your financial performance. So your VAT, is 15% if you are registered for VAT on your revenue, meaning on your sales. We know that there's income tax, which is the bottom line, the profit. Excuse me, is the tax on the profit that the business make that you need to pay over to SARS. I think we're now at 28%, and you have your QADA, you have your skills development levies that you need to pay, UIF and such things. So you need to maintain the books, or you need to maintain the business records so that you will be able to pay those statutory and legislative taxes and levies that the company is supposed to pay. All right, so that's the one side of bookkeeping, and the other side is to prepare a financial record that will show that if your business is making money or not, or if you are making economic profit. Because making money is got a different concept. The fact that the money is coming into your bank account or the clients are paying you doesn't mean you are making an economic profit. So money coming into your bank account is not necessarily profit. It becomes revenue, and you need to take into account different costs that you will incur for you to see if you are making profit. Okay, so bookkeeping mainly is got two objectives: compliance with the regulations and the law, and then the other side is you keep records to monitor or to evaluate the business performance. So those are the two things that you use the bookkeeping for. And now here we're looking at it because we have a module on tax, where we're looking at the tax, the records that you need to keep for you to prepare your tax return, VAT returns, and all the returns that you need to submit. So if you look at our tax module, you'll see where we're discussing the role of bookkeeping in that context of the compliance. So, but in this session or in the skills program, we're looking at bookkeeping from the angle of evaluating the business performance to see if the business is making money or not. So you will have your bookkeeper or your financial manager or your accounting department. Those people will receive we call it the invoices, the money that comes into the bank account, the sales and all that. They collate it, they put it nicely into accounting records. Then once they put it in the accounting records, we're going to go into details on that. Then those accounting records, they will produce what we call the financial statements. Okay. And then what are financial statements? The financial statements are mainly, okay, they have other things, notes and all that, but the main three components of the financial statement are your income statement, your balance sheet, and your cash flow. So the bookkeeper will record the transactions and in an accounting way produce, after recording the expenses, the income, the assets that you bought, recording the activities of the business. And then they will do their debit and credit and all those things. And after preparing that, the outcome of that will be your financial statements. And your financial statements are the ones that are very important for entrepreneurs to understand what makes up the financial statement, and they should be able to interpret the financial statement because they give you an idea of where your business is at, how is it performing, how is the future looking like. So when you are assessing the viability of the business, you are using what you call the financial statements. And just to go a little bit into the financial statement, because to many entrepreneurs, mainly the technical entrepreneurs, these things it's a foreign language. When they see financials, they're not interested. But that shouldn't be the attitude, because the financial statements are very important for businesses. But I know that many entrepreneurs are not preparing the financial statement for evaluating the business and for strategic objectives. No, they're doing the financials for compliance. That is not what you're talking about today. But they're doing it for compliance, to make sure that their tax returns are submitted, they get their tax clearance. That's all that they use the financials for. And that is, call it, one of the key contributors to business failing, because entrepreneurs, they need to understand how the business is performing and identify any weaknesses or where the business is not performing the way it's supposed to, so that they can put corrective actions in place and put the business back into profitability. So you might find that you're running a business, money is coming into the bank account, but ultimately you might find that you are not making money because you are not doing proper record keeping or proper bookkeeping, and you are not accounting for certain expenses. Then you'll see yourself working for years in the business, but you're not seeing progress, and you don't see where the business is going. You don't see growth. You don't see any returns, because entrepreneurs are supposed to be in business to make return on investment that you're making. There's time that you're putting in, there's risk that you're taking, there's time that the hours that you are putting in, there is investment that you've put in, the resources that you have put into this business. So you need to make sure that you get return on investment. And to see that you are getting return on investment, you need to make sure that you have your proper finance and accounting system. You account for every cent that comes through the business. So that's the basic of seeing if you are making money or not. So finance, is very, very, very critical, and entrepreneurs need to maybe take time, go through the learnings, the material, listen to the videos like this that gives you guidance on finance, so that you understand what you're performing, how are you performing. Because if you don't measure it, then you will know if you are performing well or not. And the only good measure that you can use to measure your business performance is your financials, right? And now, with the financials, as I said, that the main there are other statements that you can look at, like your changes in equity, your notes, and all those things. Those are important, but as an entrepreneur, at least you need to be able to understand the difference between the income statement, the difference between the balance sheet and the cash flow. That's very important. And we have a module, or modules for that matter, that addresses the income statement, a full module where we're just discussing what goes into the financial, into the income statement, and we have the balance sheet module, and we have the cash flow module, so that as an entrepreneur or as a manager or a business manager, you understand what goes in there and what you're supposed to be looking at, the things that you need to focus on to see if your business is performing the way it's supposed to be performing, or identify opportunities if the business is not operating efficiently. So if you want to know in terms of the financial statement, we have a full module for the income statement. Look at the income statement module, look at the balance sheet module, look at the cash flow module, and the fourth one, look at the ratio analysis. Because ratio analysis is, with accounting, you get numbers. And then those numbers, you have revenue, you have expenses, you have assets, and all those things. With the ratios tell a story about the business. They will tell you if you are making a good return on investment, if your margins are good, if you are using the assets the way you are using them, if the business has excess cash flow. It shows you the return on investment or return on equity. So, excuse me, those are ratios that you use to see if the business is operating efficiently. But we have a module that goes into detail on the ratios and how you interpret the financial statement. Today, I'm just giving you that picture so that you understand when you're talking bookkeeping, how does it fit into the whole accounting system. Bookkeeping is the beginning of the processing where the things are recorded. But those things are recorded and they go through the filter, whatever the accounting filters, they allocate it wherever they allocate it, and they end up in the financial statements. And the financial statement is what you use to measure the performance of your business. Okay, so now we're going back to bookkeeping, and I'll give you background on bookkeeping and explain how it works so that you understand what's going on when somebody say I'm a bookkeeper or I'm an accountant or I'm a business advisor. Those are different skills. A bookkeeper is a person who records the transaction and allocate them to different accounts. Money comes in, and then that money that is coming in, it needs to be recorded in an accounting system, right? As an entrepreneur, you don't necessarily have to know the nitty-gritties of what you debit, what you credit. But what you need to know is that when the money comes in, the bookkeeper will record them accordingly. Remember, the money that is coming in, it's not profit, because profit you need to take out the expenses, and the profit is what remains at the end of the day. But the money that is coming in is called sales or revenue. And I need to stress this, revenue is not profit. If you want to see if the business is making money, or if you want to go to Dubai, whatever, go on holiday, spend money, don't spend revenue. You first get the revenue, you take out all the expenses, you make all the provisions, we'll go into the provisions, and then you'll have a balance that's remaining, that shows if the business is making money or not. That's what you have to look at if you want to spend money, or you want to declare dividend, or if you want to pay yourself high salary. You don't look at how much came came into your bank account. That will be a wrong thing, and many entrepreneurs do that mistake. The important figure that you need to look at is the bottom line. After you've taken into account actual expenses, right? The expenses that you pay, like your salaries, you paid your rent, you paid your maintenance and all those things. And then you still have to make provisions for certain things like your depreciations and all that. But we'll touch on those to say, what does it mean to make a provision for depreciation and all that. And after you've done that, you're going to get the bottom line. The bottom line is the money that is available for the shareholders, meaning is the equity that's available for the shareholders. And as a business, you must have your dividend policy, meaning the money that is remaining after you spend everything, how are you going to allocate it? Are you reinvesting it in the business, or are you paying it to the shareholders as dividend? Remember, the profit is after expenses, right? So once you make the profit, you need to decide, depending on the type of shareholders that you have, are you gonna pay the money that you made, the profit that you made, to the shareholders as dividends, or are you reinvesting it in the business, meaning you are putting it back into the business so that you can grow your business further, and that money can make the shareholders even more returns. That's how the basic accounting works. So dividend policy is something that you set at the beginning of, not like as you operate, you need to have policies that you set for accounting. And how you distribute your profit, it must be based on a policy. Because if you don't set policy, you're going to see that, yeah, I have a little bit of money in the bank account, and then you just decide that you want to spend it, you want to have fun, whatever. You buy certain things that you're not even supposed to be buying because you don't have policies. And I keep on stressing that policies and procedures are critical for sustainability of SMMEs. And I know this point is ignored by many research, because they'll tell you about access to funding, access to markets, poor financial management, and all those things as the reasons or the causes of many business failures. But lack of systems, for me, is the main cause of small business failing or small business not growing. They don't grow because they don't have systems and procedures. They don't do things consistently. They don't have the discipline to follow a certain system. So the first thing that you need to have is to have your financial management system. And then within the financial management system, it will decide, or it will dictate how your finance department work. If you don't have the finance department, how your accountant is supposed to be working. It will give them guidance in terms of what are your expectations. So the start in terms of when you're looking at the bookkeeping, you need to have the financial management system in place. Yes, you can use your Pastel, your QuickBooks. Those are the accounting systems. So you record your transactions in the accounting system. But sometimes if you can't afford it, you can use your Excel. And you can also, if you want just for reporting, you can use Super Dealmaker. We've designed a nice application where if you load your transaction, it will generate the income statement, balance sheet, and cash flow for you. So it will generate your balance sheet for you. So you don't necessarily need to have an accountant prepare those for you. Okay, I'm not saying you shouldn't have an accountant. You should always have an accountant. But you must not be paying an accountant for preparing your accounting records. You must be paying an accountant for the value that they add, the advice that they give you, the interpretation of the numbers. Because you can, with the bookkeeping, preparing of the accounting records, a matriculant can do it. A first year BCom graduate can prepare the financial statement for you. Okay, obviously the skills, they might make mistakes because they don't have experience and they don't have the skills that maybe your chartered accountant will have. But what I'm saying is, if you learn or if you have a system on to do the basic bookkeeping, then you might not need the accountant to do the bookkeeping for you, but you'll use the accountant to interpret the financials for you, to give you guidance in terms of where you can improve the financial performance, the strategies in terms of funding, which money should you use, so dividend policies that you need to implement, investments that you're supposed to make, which assets are you supposed to be buying, and what will be the return on the assets, which ratios are weak that you're supposed to improve, or how to improve those. That's what you're supposed to be using the accountant for, not to do your basic bookkeeping. It's easier. You can find anyone, not necessarily anyone, somebody with a background of accounting, or if you have the system like your Pastel, your QuickBooks, then they can prepare the financials for you, because you just have to understand. You click here if it's a revenue, you click here if it's sales, then you just put the numbers in there. Then that system at the end of the day, it will generate the financial statement. Then that's when you engage the accountant to say, look, I've generated these financials, now let's talk business. I need advice, input. How? What's happening? Help me interpret this. But as I said, that even Super Deal Maker, we have an app. You just put your expenses or your transaction on an Excel, then you upload it into the system. The system will generate the financials for you. We made it easy. But it doesn't mean you don't need an accountant. You still need an accountant, but you don't need an accountant to do the basic work. You need the accountant to provide you with guidance, with advice, with input on how you can improve your financial performance. When you're having your meeting with the accountant, it shouldn't be about tax clearance, please. It should be about how is the business performing? Where can we improve? Where are the areas that there are gaps? What can we do to grow the business? How can we do to utilize funding, different funding? How can we maximize our return on investment? Those are the kind of discussions that you're supposed to be having with your accountant, not if you are tax compliant. That is it's for the bookkeeper. It's there for the section that we're talking about today. That is for a person that even an administrator, they can do bookkeeping. You just have to teach them the system. If you have a proper system, but if you are using Excel, then you might, because some things might not balance, because Excel is Excel. It's prone to errors, and formulas might not be structured correctly. So using an administrator, you might have the books that are not balancing. Then maybe you might be needing someone with a little bit of experience to help you prepare your books. But if you have an accounting system, an administrator can do the bookkeeping for you. But engage with an accountant when you want to interpret the financials rather than preparing the financials. So I just wanted to separate the two, to say what you're looking at is bookkeeping today, but with the financials, please mustn't be concerned. Not only concerned about your tax clearances and all that. You need to understand the financial performance, the investment that you made, the returns, the efficiencies, the ratios. So, but with this program, we're taking you through the financials so that at the end of the program, you will be able to interpret and ask the right questions, because most of you are not accountants. So even though you are not an accountant, but when you're looking at your financial statement, you should be able to ask the right questions, identify areas of improvement. And that you can only do if you have a bigger picture on how finance is working, how it's supposed to be working, and then how the report's supposed to be looking like, and what you're looking for in those financial statements. Financial statement, we find that it's a 20-page document or whatever, 10, 15-page document, including the notes. It gets so confusing, you don't know which numbers you're looking at. So what we want to do with this program is to help you know the numbers, understand which number you're supposed to be looking at and what does it mean, so that you will be able to interpret the financials. Now, with the bookkeeping, we're going to go through in terms of the basics. What is bookkeeping? How are you supposed to do it? And then the policies that you need to put in place. Now, what is bookkeeping? Bookkeeping is, call it a process or a system where a business is supposed to record the transactions that are happening within a finance. Okay, from the beginning to end, you need to make sure that you keep records of the activities that are going on in your business, because you don't know when SARS can come and visit you. But generally, how it works is you keep financial record from financial year end to financial year end. So you must group your financial records from, let's say, most businesses, they have a February year end, because they want to coincide it with the SARS year end. So from March, 1st of March to 28 February or 29 February, that's your financial year. So when you're doing the bookkeeping, you need to make sure that you keep the records for that period, so that when you report for that financial year. Those things are called financial year. So some businesses have a year end that's ending on the 31st of December, some is June. It depends on the type of financial year end that the founders or the shareholders or the owners of the business decided on. But most businesses, as I said, they have a February financial year end. So one thing, just remember that a business is an independent person according to the law. It's a fiduciary person. It's a statutory person in terms of they have their own rights in terms of when it comes to the law. So your business and you, if you are a shareholder, you are separate legal entities, right? So the business financial year is decided by what they call the memorandum of incorporation. You know, like when you register the business, it will have that memorandum of incorporation. That you'll define the number of shareholders, number of shares that you are issuing. You also define your financial year end to say our financial year end will start from, let's say, 1st of March to end of February. And when you are doing bookkeeping, you keep the records for that financial year, and then you close the year, and then you start the next year from the 1st of March going forward. So when you're keeping those records, is to show that these transactions happened in this financial year. Why is it important? One, to see how you performed in that financial year. And two, to comply with the statutory requirement, like you're submitting your tax returns and submitting your VAT returns and so on. So you keep your books for a specific financial year, and then you close the books, meaning those records are locked in that 12 months or whatever, depending. If it's the first year of operating, you can go up to 18 months until the financial year end, and after that you maintain your records for 12 months. To keep the books, it means recording the transactions. So it's either you have an accounting system, formal accounting system. If you can afford it, I recommend that you need to keep your accounting records in a formal accounting system. Like some, they are like your QuickBooks, your Pastel. They have their like a low-end products that you can use. Most especially if you are generating income. If you are still a startup and you haven't started generating revenue, you can still keep you can prepare your accounting records using Excel. It's all right. You don't have to spend money on a system that you're not going to be fully utilizing. But if you are generating regular income, you need to maintain the accounting system. Why? Because without the bookkeeping records, you will not be able to show how your business is performing. Excuse me. And SARS later on might come knocking to say, show us your financial records, because we believe that you're not declaring proper income, or you're not submitting accurate tax returns. And without the financial records, you wouldn't be able to prove that what you have submitted is accurate. So they might charge you penalties and all those things, and start to liquidate you. So you don't want to be playing in that space. So it must be something that you start with. Once you start generating proper income, make sure that you have proper accounting records so that you can account. Accounting records, accounting is to account so that you will be able to show that this year I performed like this. These are my financial records. And keeping financial records as well, it will be able to give you a trend in terms of your business, to say in maybe 2020 you performed like this, 2021 you performed like this, 2022 you performed like, and then in 2023 you performed like this. So if it gives you a trend, and generally we have the term in finance to say a trend is your friend. So if you're looking at the financials and there is a trend, you can see where you're going. Or if it's a downwards trend, it will be able to give you a heads up in terms of the issues that you're supposed to focus on. So keeping your accounting records is critical for many reasons. But most importantly, it's for compliance, making sure that if anything happens, there are records to prove certain things. And the other important one is to show or to be able to generate the financial statements to see how your business is doing. And maybe just to go in, bookkeeping it's a simple process. The person receives your transactions, meaning he receives, let's say you receive your bank statement, and then you receive the invoices, you receive the income. Some businesses, remember, you also have cash and all that. So you might find that your income, not all your transactions are going through your bank statement. There are certain transactions that are cash, and then you once you receive the cash, maybe you use it as petty cash. You buy certain things on cash, so that will not be on your bank statement. But when you're doing preparing the accounting records, when you're doing a bookkeeping, you take the bank statement, and then you take the petty cash, or the cash that is being received, the transactions that were conducted through cash. Then once you have those, then you record them in an accounting system, or if it's an accounting system, you have an accounting system, you record them. And if you are using Excel, you record them on Excel. So on one side, you put the expenses that you paid. And on the other side, so on the debit side, let's call it on the left-hand side. Let's say you have two columns. On the left-hand side, you put your debit, which are your expenses that you paid. And then on the right side, which is, they call it a credit, you put all the income that you received. But you need to have the basic understanding on that these expenses, should they be in the income statement or balance sheet? Meaning, the income statement transactions are transactions that are happening within a year. Let's say you are paying for rent and all those things. You are paying for rent, stationery, electricity, those things. Those expenses, they need to be sitting on the debit side in your income statement, because income statement shows you income and expenses. So, and then on the income side, you show the revenue that you receive from clients. Let's say you sell stuff to clients and all that. That's what you record on the right hand side as income. So you record all the income that you received, and then you have a total that will make your total sales or your total revenue, right? And then, but you need to exclude if you received a loan from a bank, that's not an income. It's actually, even though you are receiving money into your account, but it's what is called a liability. So that it goes to the balance sheet, meaning it's a long-term thing. Even though it's an income, you received it, but you still have to repay it. So it's not an income as if you've earned it, it's yours. No, it's money that you borrowed that you still need to pay back. That goes to the credit side in the balance sheet. And then on the expenses side, as I said, that you record on the left-hand side, which is the debit, you record all the expenses, your rent, your stationery, your salaries, your telephone, and all those expenses you use to run the business. So basically, it's all your operating expenses. So once you took the sales or the revenue, the income that you received from the total, then you minus the expenses that you have paid. Then you get to what it's an operating profit. So if your income is more than your expenses, then you have what they call an operating profit. Then from the operating profit, then you have what they call depreciation. Depreciation is when a business has assets and then they are using the assets for production. And remember, the assets meaning like your laptop, your car, your furniture, your equipment, the things that you're going to use for more than a year, they are called assets. So if you have stuff that you're going to use for more than a year, then you need to record them as assets, not as the expenses. So you take them to your what is called the balance sheet. So in the income statement, you record the expenses that are for operational, paper, employee salary, electricity, and such things like that. And then once you recorded those on the left hand side, which is your debit, then on the credit side you recorded your income. Then you take the total of your credit side, which is your income, you minus the left hand side, which is your debit, which are your expenses. Then you're gonna get what you call operating profit. But it doesn't end there. You must also look at your assets to say, these assets I'm using, they lose value. So if it's an equipment, generally you depreciate it over 5 years. If it's a furniture, they do it over 10 years sometimes. If it's a computer or software, you depreciate it over 3 years. Meaning, you take the value of that asset, you divide it by 3 if you are depreciating it over 3 years. If you're depreciating it over 5 years, you take the value of that asset, you divide it by 5. If it's 10 years, you take the value of the asset, you divide it by 10. Then the value that you get, you have to record it as an expense. Because the asset, you are using it, you are making money, but it's losing value. Because if you don't do that, at the end of the day, you might look at your books and think you have an asset that is worth 20,000. But that asset at the time is no longer worth that because you've been using it and it's lost value over a period of time. Once you get your depreciation, that's what is called depreciation, then you minus your depreciation from your operating income. Then you get what is called your net profit before interest. Then if you owe people, they charge you interest on what you owe. You must also minus it from there. Then you get your net profit. So it's what is called profit. That's where now, as an entrepreneur, you know that's the money that's available for either distribution as dividends to shareholders, or you can reinvest it in the business. If there's the money that you want to spend, it must be the money at the bottom, after you've seen how much profit you have made. But keep in mind that you should have already have paid all your creditors in terms of the creditors that they've paid you, or the creditors that they might have given you a loan. So here I'm trying to simplify the bookkeeping process for you to understand how you keep your books. So therefore, the income that's coming from your customers, you record it as revenue or sales. The expenses that you pay for normal operations, your rent, your salaries and all that, you record them as expenses in the income statement. And then the difference is what is called a profit. And then when it comes to the expenses that you pay for assets, things that you're going to use for more than a year, you record them in the balance sheet. Same thing, on the debit side, you're going to have all the assets that you bought in the year. On the right hand side, you're going to have the money that came into the business, like in terms of the loan. If you got a loan from the bank, if you have overdraft, if the shareholders have put in a loan into the business, you put it on the credit side. And then the difference between what you spent on assets and what you borrowed, it becomes your equity. So the equity is a difference between your assets and your liabilities. The liabilities are all the amount that you owe people, right? And the assets is all the expenses that you paid to buy assets. And also in the assets, you include all the monies that you are owed by your customers, by whoever that is owing the business. It becomes an asset because when you receive it, you're gonna get value from it. So it's classified as an asset. So now I'm just giving you a broader explanation of how you do your accounting records, how they're supposed to look like. Because now what they're doing here is what is going to translate into your financial statements that we will be discussing later on. So you must have a basic knowledge of how it works. And I'm doing it intentionally by explaining it rather than demonstrating it, because sometimes you auto-crema what I'm showing you rather than what to understand the concept itself. But the important thing is to understand the concept, to say what is bookkeeping, what are they doing in the background there. They're basically recording the transactions, and because they have the industry, whatever, they have the understanding of accounting, they know what's supposed to be classified as an income, what is supposed to be classified as a liability. So in the balance sheet, the money that's coming in is either an income or it becomes a liability or equity. Liability, or if it's coming from shareholders, it becomes equity. So you need to decide which side is it going. Is it an income from your customers, or is it a liability that you need to pay back? If it's a liability that you need to pay back, it goes to what is called a balance sheet. And if it's an income that you received from your client, it goes to the credit side in the statement that is called the income statement. That's the money that's coming in. That's the basic things. And the money that's going out, the money that you are paying, if you are paying for simple operating expenses like your rent, you're paying employees and all that, it goes into the income statement as an expense. And if you are buying the assets, you are spending money buying the things that you're going to use for a longer period of time, like your laptop, your desk, your camera, then that you need to classify as an asset, and it goes to your balance sheet. So you need to understand these two statements to say what goes into the balance sheet, what goes into the income statement. In the income statement is the income from your customers, is the expenses for operating expenses, not long-term expenses. Okay, and then in the balance sheet are the expenses that you pay to buy long-term assets. Okay, if you are entertaining clients and you buy them lunch, whatever, then you record it as an entertainment in your income statement. But if you go to whatever shop, you buy your laptop, when you come back, you record it as an asset in your balance sheet. So those are the two statements that are mainly used by bookkeepers. And then bookkeepers, okay, they don't go much into the cash flow, because the cash flow is the result of the two statements. It's not something that goes into the cash flow directly. It's derived from the income statement and the balance sheet. But these ones are the ones where you go and record transaction in. So you record transactions in the income statement and in the balance sheet. But in the income statement, you record the income that you receive from your clients and the expenses for operating expenses that you use month to month or within days and all that. In the balance sheet, you record long-term stuff. When you buy in the physical assets that you're going to use for a long term, you put them in the balance sheet. If it's a liability that you're going to repay over a longer period, then you put it in the balance sheet. And from the balance sheet and the income statement, then it gets complicated where you have to generate the cash flow. But I'll explain the cash flow, how you generate the cash flow when you're doing the cash flow statement. But for now, you just need to understand the simple bookkeeping to say, this is what the bookkeepers are doing. That's all that they have to do. And once they recorded the transactions, remember, as I said earlier, the transactions should be recorded within the financial year that they occur, so that you will be able to report what was happening in that financial year. And if you do the report, make sure that the dates that you use to record are the dates on the invoice, not the date that you are recording the transactions. Because when you're pulling out the income statement, it must reflect on when those transactions occurred, not when you recorded them. So when you're putting the date on the transactions that you recorded, you make sure that you use the date on the invoice. And as well, when you're recording transactions, if those transactions are more than 3,000, you need to make sure that if you're paying for something, they must give you a VAT invoice. If you are registered for VAT, but you must have invoice. For everything that you're recording, you must have the supporting documents, right? And then with the supporting documents, you must also have your accounting policies. To say, sometimes you can have a policy to say any expenses, even if it's for a laptop or whatever, if it's not more than 5,000, you write it off as small asset in the income statement. You don't record it as an asset. You can have that policy. You can have a policy to say, if you bought a laptop, you depreciate it over maybe 3 months. No, 3 years, sorry. That's the policy that you need to have written down. It will guide you in terms of how you account for certain transactions. So you must understand your accounting policies. Because sometimes you don't know, most entrepreneurs, if you can ask them, how do you account for certain things? They don't know. No, you must speak to the accountant. But it's the duty of you as an executive or as the owner of the business to understand the basics around bookkeeping. How do you keep the books? What policies have you implemented? Even if the accountant can recommend policies, you need to understand those policies. Hence, I was saying earlier to say, look, you mustn't use accountants for preparing financials so that you can get your tax clearance. Those financials have a valuable information that will guide your business. Make sure that when you have an accountant, I recommend you need to get a competent accountant. But if you can't afford it, then it's understandable to get any other accountant. But get a competent accountant, because they become a very important stakeholder in your business. Their contribution, even though now most entrepreneurs they don't really recognize accountants as important in the business, because they just want them for compliance. Okay, personally, I'm a professional accountant, but I'm not practicing accounting because small businesses, they don't see accounting as a value-adding profession or a value-adding expense in their business. Because as an accountant, I'm expecting that if I'm doing the books for you, you don't just want them to balance and for you to get the tax clearance. You're supposed to wanting them to use them for business decisions. You need to be able to interpret these financials so that you can make an informed decision. So you need to understand these basics, like in terms of bookkeeping. Why are you keeping the records? You're keeping the records to make sure that, one, you are compliant, but two, to make sure that you produce the financial statement that you're going to be using in your decision making or strategic formulation and all that. And in the background, you can use different systems. You can use a manual system, which is the Excel, or you can use the normal books. But that one, the problem is you don't have the backups and all that. If you lose that book that you're recording, the physical book, then you've lost your records. But if you're using Excel or maybe even Word, but you need to use Excel because it can calculate and all that. You don't have to have a calculator adding up the stuff. Because if you're adding up the stuff, that's where the mistakes happen, and then you might be recording wrong transactions. But you need to understand what goes on. What does the bookkeeper do? They record your transactions. How do they classify this transaction? Develop interest to see, okay, here's the income statement. What does the income statement mean? So that even when the accountant is presenting you with inaccurate numbers, you must be able to question them. So the important thing is you should be able to analyze the accounting records or the financial statement, ask the right questions. This session is not necessarily for you to be able to do bookkeeping. I don't expect you to be able to do bookkeeping, but I expect you to be able to interpret the financials, to have an idea to say, no, but these financials they don't reflect the performance of my business. Because I know I've generated so much revenue. I know my expenses. There are certain expenses that are not accounted for. And the last thing that, maybe not the last thing, but the one important thing that I want to mention is that, look, entrepreneurs, understand when you start a business, initially the business cannot afford to pay you. But it doesn't mean the business doesn't owe you. Because remember, I said you are separate legal entities, you and your business. So you should make sure that even at the stage where your business can't afford to pay you, but you must still account your salaries. You must still charge your salaries to your income statement. And because they won't be paying it, then you can put it in the balance sheet as the business is owing you. So you need to know your worth because you are not a charity case. A business is an independent institution. You are independent. Whatever you do for the business, you need to be paid. So when you're doing your accounting, bookkeeping, you need to make sure that you account for even your salary. What is the business supposed to have paid you? Even if there is no cash at the time to pay you, but you need to record it as liability so that the business will know that it owes you. You don't know, you might be building a massive business and later on some partners want to come on board. And you say, no, but I worked and the business was not paying me. No, you should be able to show that, no, since we started, this is how much I'm supposed to have been paid, but the business was not paying me. Here's the liability of my contribution that the business is supposed to have paid but didn't pay. It's your sweat equity that you've put into the business. And by putting your salary or what you're supposed to have earned in your income statement, it will help you to indicate if the business is profitable or not. Because without putting your salary through in the income statement, the money that is remaining at the bottom, you might think your business is very profitable. To only find out that, no, they have this charity case that the business is not paying. So it's not necessarily profitable, it's just that it's not accounting all the transactions that are happening within the business. And another thing is, you're doing your accounting or your bookkeeping, make sure that you separate your personal transactions from the business transactions. Make sure that you have open a separate bank account for your business. And if there are any transaction you're using the business bank card to pay for personal transaction, that's the business paying you. It's either it's giving you a loan or it's paying you a salary. So you must account it as such. Make sure that your accounting records are complete, because that's the basics. Once you start formalizing things like that, then you know that you are running a proper operation, where you are separating the accounting records or the books, your personal books, with that of the business. They're two separate things. So avoid mixing them, because now they create confusion. You won't be able to see the true performance of the business. And it even confuse the accountants. You end up now being surprised when SARS comes knocking to say, hey, we've seen this. These expenses don't make sense. Or this income and all this doesn't make sense. How did you calculate? Then you are caught in your 6s and 7s. You don't want that. Run a professional operation. Separate your personal expenses from that of the business, so that it's clear what's supposed to be accounted for the business, what's supposed to be recorded in your financials for the business. So on the bookkeeping side, it's just to make sure that you have the records. You are keeping the records of all the transactions that are happening. You are counting them in the right statement, in the right period, in the right month. Make sure that you do that so that you have the records. But use the financial report that are produced by that bookkeeping activity to see how the business is doing. Interpret it, see where the business is, and identify any weaknesses or any opportunities to improve your business. I must stress this: bookkeeping is very, very important. Don't leave it to your administrator or to your accountant to do. Even though they're doing it, but you should be able to interpret what is produced. Because what is produced from bookkeeping is called the trial balance. It's got the negative and credit. So you'll have the top one where it shows you the income statement, where it shows you the income from your clients, the operating expenses, and it shows you the profit. And the bottom one, it will be a balance sheet. It shows you the expenses that you spend on assets and the money that came into the business, not from your client, but from either you or from the bank as loans. And the trial balance will be used to generate your financial statements. Okay, now the key lessons from this module, which is called bookkeeping, is that please understand that accounting is a process designed to help you account for the transactions that are happening in your business, and is to help you interpret the performance of your business and to make sure that you comply with the legislation. You'll be able to submit your returns and all that. Remember, with bookkeeping, you need to account for yearly, meaning the transaction that happened in a specific year must be recorded and dated in that year, so that you know how you performed in that financial year. So don't use the date that you're recording the transaction, but you use the date of one of the invoice that was issued or that one that was received to record those transactions, so that they get accounted in the right period. And with bookkeeping, make sure that you have policies in place in terms of when you close your books, when are you supposed to issue your management accounts. Management accounts are the reports. Normally, if you have a proper governance structure, you'll find that maybe you have a board or you have the management team. So regularly, make sure that on a monthly basis, you keep the records. You are able to record your transaction and produce the management account, so that month to month, you can see where you are in terms of performance, so that you can take the corrective actions earlier on, rather than waiting. I've seen small businesses say, we haven't prepared financial statement for the last 3 years. And you're surprised that you are struggling. You don't know what to do. You don't know where you are in terms of the financial performance. So making sure that you keep accounting records is critical. It forms the very basic of building a sustainable business. And bookkeeping is one of the systems that, if you start with that, they lead to other things. Because if you have a proper accounting system, you know the things that you do. You know how you make decisions. Your financial decisions will be guided by the financial records. You are not impulsive as an entrepreneur, because you'll be guided by what is produced by your accounting records. Can you afford this? What did our policy say? If we made profit, can you blast it on, I don't know, parties and all that? Or should we blast 30% and 70% be reinvested in the business? So you must have your bookkeeping or your financial management policies and procedures. And if you want guidance in terms of developing those policies and procedures, you can use our Super Deal Maker app. There are automated policies and procedures on financial management, when you're supposed to issue your management account, when you're supposed to issue your financial statement, when you're supposed to submit your VAT returns and such things. Developing policies around each and every section of your business will go a long way to making sure that you build sustainable business. But on the bookkeeping, make sure that you keep records, you keep transactions, you keep the invoices. Remember, in terms of the law, certain records need to be kept for at least 5 years. And if it's the property and other complicated things, some they go up to 10 years. But you must always have your accounting record. You mustn't record transactions and throw away the invoices, because you don't know the day that SARS might come knocking. So you must make sure that you maintain your accounting records, you maintain them in a system. Because sometimes you find entrepreneurs say, no, where are the invoices? Where are your transactions? No, I've given them to my accountant. No, it doesn't work like that. It's not the accountant's responsibility to make sure that you keep your accounting records or you keep your books. Accountant is there to help you, yes, but it's your responsibility as an entrepreneur to make sure that you keep the records, and when those records are required, you are able to produce. And it's very important even for business continuity to know what you bought when. So you must have that system where you retain records, you properly maintain a proper accounting system to be able if you have a proper accounting system, it will allow you to pull out reports to see how have you been doing, how much have you been spending on certain items. And that will guide you when you're developing your strategy or you're doing your performance management. So bookkeeping is critical for entrepreneurs. Yes, you don't have to do it, but you need to understand what's going on. How does the bookkeeping work? Where, if a transaction happened, where is it recorded? Is it the income statement transaction? Is it a balance sheet transaction? Is it an income, or is it a liability, or is it an equity? Is it an expense, or is it an asset? So that when you're making decisions, you know the expenses that you're expecting and the assets that you're expecting to see on your financial statement. And lastly, as I said, even if the business is not paying you the salary, but you must still account for that salary so that your profit truly reflects the actual performance of the business. It's not inflated, because if you ignore your salary, then it will appear as if the business is making money, but you might find that actually if you put in your salary, the business is not making money. And the other thing is, remember, there is always depreciation. Don't forget about it. If you have assets, the assets won't last forever. So you need to make sure that you depreciate them and you take that expense to your income statement. So the bottom line will be after you have taken out the depreciation. And why should you do that? Because the depreciation, as the asset loses value, at the end, you have to replace that asset. So that depreciation that you put in through to your income statement, you must make sure that you reinvest it, so that when time comes to replace that asset, then you have put a value, or you have saved, or you have an investment that you're going to use to replace the asset. That's as well the intention. This is when keep in mind that you are growing a business. Because if you don't do that, you'll be surprised that at the end of 5 years, the laptop is breaking and you always have to call the person to fix it and all that. But If you reinvest that depreciation that you've put through, then you know that when the time comes, you're not even stressed. You just take it out of your reinvested depreciation and you buy the new laptop and you go. So lastly, it's important to maintain the system. So make sure that you have proper financial management system and you are keeping your books the way you're supposed to. I thank you.